Hello, everybody. Very warm welcome from Frankfurt, from SAFE, the Leibniz Institute SAFE. SAFE stands for Sustainable Architecture for Finance. And our mission for a long time has been to contribute to public debates. Our mission also allows us to treat topical issues. So we have excuses. Financial stability is very much a topic which refers and relates to many domains, and in particular it refers to fiscal and monetary policy. So those are inexorably connected with financial stability issues, and we use it as an excuse to think about one of the most topical issues currently, which is fiscal policy in its short-term stabilization dimension, as well as in its longer-term growth-oriented, longer-term perspective. And what we find in many debates currently is the apparent or obvious divergence between what is happening in the US with the new incoming administration and what is going on in Europe. Are they moving on different wavelengths? Are they behaving? Are they diverging? And if they are, what are the consequences of that? Now, it is, of course, important to understand that, and most obvious, that most of fiscal policy is done in Europe at the national level. In many places, actually, the subnational, even the municipal level is very important. It holds true for Germany, where more than half of all public sector capital expenditures are done by municipalities. So taking account of that leads to a host of very interesting issues and questions. We are throwing around really big numbers here. We are throwing them also around now at the EU level in terms of implementing, and the last hurdle probably has been pushed away yesterday by the German Constitutional Court's judgment, 750 billion next generation EU program. And we are privileged here to have very distinguished panelists to discuss this. I start with Jeffrey A. Frankel. He has a very complicated title, which I have to read off, which goes like James W. Harper Professor of Capital Formation and Growth. Jeff is one of those who are in charge of calling the cycle. He is the chair, I guess, of the NBR.
Actually, no more. I've stepped down off that committee, Hans-Helmut.
Sorry for that.
After 25 years.
Jeff, you have to correct it on your homepage. Anyhow, what I really wanted to stress is that he's been thinking about important applied issues long before they popped up in other fields. For example, if you would like to go into debates about climate change, Jeff has been dealing with that as a member of the Council of Economic Advisors in the Clinton administration. So happy to have you, Jeff. We have Agnès Bénassy-Quéré, who is, like Jeff, an economist who's been investing lots of her time in international policy coordination issues. She has a marvelous book on a textbook on international policy coordination. And when she saw what was happening, the first thing she did, she wrote a blog on the website of the French Treasury using a very simple model to figure out what might happen. So I'm not referring to that book. I'm referring to her own book on international economics. Now she is chief economist at the French Treasury. And by the way, I guess at least for the third time with SAFE. Finally, and of course not last, Jakob von Weizsäcker, who's also been a number of times with us. Jakob is possibly most known in European circles for his work, which he did at Bruegel, about thinking how to get a common debt issuance facility capacity. That would really have been a Hamiltonian moment. And he suggested that, please correct me if I'm wrong, in about 2009 or so. He's now chief economist at the German finance ministry. And correct me both, Agnès and Jakob, I have the hunch that you are also somehow behind this next generation EU program, in particular behind this significant grant program. So this is my introduction. Hope it was not too long. I now hand over to Jeff.
Well, thank you, Hans-Helmut, for that introduction, and thank you for inviting me to this panel, and it's an honor to lead off the panel. So I've been assigned to talk about the US situation with respect to the fiscal stimulus, and the question that everybody's asking is, will the US fiscal stimulus overheat the economy? And the reasons to think that the answer is yes are pretty familiar by now, I think. Most recently, we've had the President Joe Biden getting through Congress the $1.9 trillion relief package, which is called the American Rescue Plan. They don't call it fiscal stimulus, but it has that effect. And now they're moving on to the infrastructure bill, which is $2.3 trillion. Called the American Jobs Plan. Neither of these numbers should be associated solely with the year 2021. A little over half of it is 2021 in the case of the 1.9 trillion, and some of it goes into 2022. And the infrastructure spending is spread out over 10 years. This comes on top of equally big programs in 2020 when the coronavirus recession first hit in March, and again in the renewal in December. And a lot of that was saved, but the estimate is that the $1.5 to $2 trillion of extra savings is sitting there in the bank accounts of American households. And presumably they'll start spending it when they're able to go out to shopping again and traveling and so on. So that's pent-up demand. We saw that at the end of World War II, a big burst of spending because of pent-up demand. And then throughout, we've had very aggressive Fed stimulus, aggressive by historic standards or by any standards. Just to summarize what I'm going to say in my 8 to 10 minutes, my bottom line is that US overheating is indeed very likely. If you define overheating as actual GDP goes above potential GDP. But if you define it as inflation getting out of control, then I think it's much less likely, or somewhat less likely. The Fed has said that they wanted inflation to go above 2% for a little while. And by this definition, I think overheating is less likely. So let me go through it a little slightly more detail. It's basically good old Keynesian multiplier logic. I guess Keynes was considered a pejorative term, Keynesian, but certainly the logic is used by policymakers when they're in a position of excess supply, when the output falls short of potential, employment falls short of the natural rate. The logic was made very prominent by Larry Summers in a column in the Washington Post on February 4th. And basic idea is pretty simple. The Keynesian multiplier is normally thought to be quite high when interest rates and inflation are low and remain low, maybe 1.5. I'm going to call the multiplier 1.0 because a lot of the spending is transfers. Certainly, a lot of the 1.9 trillion for this year is transfers, much of which will again be saved. And then also, even though the Fed is determined to hold short-term interest rates at zero for quite a while, the longer-term interest rates are sort of more important for determining aggregate demand, and they have already begun to rise since, particularly in February and March. They're now at 1.6%, the 10-year government bond rate, and it could certainly go higher. We could have some crowding out in private demand in textbook terms. Anyway, the basic logic is if the multiplier is 1, 1.9 trillion is 9% of US GDP, and that suggests a boost to GDP of 9%. At the end of 2020, US GDP was estimated to be 3% below potential. This is Congressional Budget Office's estimate. So if you add 9% boost to a 3% shortfall, you get a 6% estimate of 6% GDP above potential. And that's huge. That's a lot. That's more, the record was in the 60s, and I think that was 5% actually realized. Some people say the multiplier is less than 1. Call it 0.5. That still would put us above potential. And just to show you the graph of the output gap estimated by CBO, before the pandemic in 2019, GDP was 1% above potential. At the trough, the bottom of the crisis economically, GDP was 10% below potential. So here's at the end of the year, the beginning in January 2021, the estimate from CBO was that GDP was still 3% below potential, and expected to converge very gradually. But if you add the stimulus in 2021, 2022, regardless of what your multiplier is, you're going to get that GDP is above potential. Just to do the international comparison for a moment, last year in 2020, there wasn't such a big difference between the US and other major industrialized countries, all of which did more than the emerging market developing countries felt able to do. But in terms of the new fiscal support, which has been taken place or planned this year, the 1.9 trillion plus the infrastructure bill, the U.S. is way ahead of other countries, or for better or worse, doing far more. Now, we could talk about automatic stabilizers in Europe, which might equalize it more. But in any case, the estimates are, this is from the OECD last month, that this is going to put the U.S. on a rapid growth path, where by the end of this year will be above potential, and next year well above potential, while Europe and Japan will not. The major counter argument against this argument that output is going to be above potential is we may be underestimating potential. And after all, it's very difficult to estimate. There's different methods, different answers. And the proponents of this view point out that before the pandemic in 2018, 2019, I've showed you in the graph that the estimate was GDP was 1% above potential, and yet inflation hardly rose at all. So maybe we were underestimating potential and overestimating the natural rate of unemployment. Maybe unemployment rate could actually go below 3.5% without being inflationary. It fell as low as 3.5% in 2019. Well, in my view, a better explanation for this episode, why we didn't have much inflation in 2019, is that the Phillips curve is quite flat. After all, inflation also didn't fall very much in the years 2011, 12, 13, even though output was still below potential, and unemployment was declining only slowly from its 10% peak in 2010. So the same theory that says that inflation should have gone up more in just before the COVID-19 pandemic says that it should have fallen more 10 years before. And I think the answer that is capable of explaining both episodes is not that we've got potential output particularly wrong, but that the Phillips curve is quite flat. So that's my conclusion, that even though GDP in the next year or two will go above potential, it is less likely that the inflation will go above what the Fed wants. That's not to say that there are no other downsides to having so big an expansion. And my first choice would have been that both the 1.9 trillion and infrastructure spending, I would have cut a bit out of both of them. Not as much as even the moderate Republicans, so-called centrist Republicans, wanted to cut, but at least a little bit. But net national debt to GDP is now above 100%, which is equal to the record at the end of World War II, the highest since 1945. I've got a graph for that in a moment. This will be an unsustainable path, meaning ever rising in the future ratio of debt to GDP, if interest rates rise at all as much as we normally think they do in times of booming economy and rising debt to GDP ratios. This is less of an issue for the US than it is for Europe, and less of an issue for Europe than it is for developing countries, to be sure. But I think maybe it's a possible issue for everybody. And I have colleagues who say we shouldn't look at the debt to GDP, the level, because that doesn't tell you much if interest rates are low. Well, that's true. But if you might be on a path of unsustainable, ever rising debt to GDP, which we will be if interest rates normalize or even halfway normalize, then it is an issue, even for the US, and especially so for emerging markets and developing economies. Well, another argument, and another possible downside is, let's say the Fed succeeds in keeping interest rates low, that may prolong asset market bubbles. Everyone has their own view, but to my view, the US stock market is kind of unaccountably high, or it's accountably high because monetary policy is so easy. But eventually that is likely to reverse, I would say. Here's one that is not on people's lists automatically. A pretty certain consequence of this big fiscal expansion is that the US trade deficit will rise, like it did after the Republican tax cut in 2017, the corporate tax cut. I myself don't worry so much about the trade deficit. It could be a useful safety valve to relieve some of the pressure from the overheating and prevent it from showing up more in the form of inflation. But my fellow Americans do worry about it, particularly the politicians, and it could exacerbate protectionism. Finally, much depends on how the money is spent, and I think the money is being pretty well spent. There's a few things I might change, but the infrastructure spending is a lot of it is transportation infrastructure, road and bridge repairs, charging stations for electric vehicles, school upgrades, hospital upgrades, upgrading the water system by replacing lead pipes, bringing broadband more widely. And then some of it doesn't really deserve to be called infrastructure. I think they're stretching it a bit to call it when they call it that, but help for caregivers for the elderly, and it's other money which I think would be mostly well spent, even if it's not properly called infrastructure. So here's a ratio of U.S. debt to GDP, and this is federal debt held by the public, not counting what's held by the Fed or others. Until pretty recently, we had, the peak previously had been at above 100% in 1945 to fight World War II, and then we brought it down progressively in the late 40s, 50s, 60s, 70s. That turned around with the Reagan tax cuts, and there's been an upward trend since then. But the trend particularly accelerated in the Great Recession and again in the pandemic. And even before, this is from Congressional Budget Office, before the most recent spending bills, and already it was projected to go above 100%, then to kind of level off. But then we have over the next couple of decades the continued retirement, I should say, of the baby boom generation, and spending on the health programs and pension programs, Medicare and Social Security. So that looks unsustainable, and this is even meaning ever rising. And that was, at least that's what we would think if it were any other country, or certainly if it were a developing country. And this is before the most recent stimulus. So it makes me worry a little. I want to conclude by talking about the mistake of 2009, which is now widely discussed, at least widely discussed among Democrats. Obama, to remind you, took office with Joe Biden as his vice president in January 2009 with the economy in free fall. The Fed eased sharply, and the Obama White House got a $0.8 trillion stimulus through Congress, which at the time seemed very large, but in retrospect, it wasn't enough. Or even the estimates of the economists in the White House at the time said it wasn't going to be enough. It did turn around the economy, but not enough to rapidly eliminate the recession or the output gap. And especially because it was short-lived. It took effect in 2009, and the recession ended, but growth was pretty slow thereafter. And partly that's because after the Republicans retook the House in the elections of 2010, there was no possibility of further stimulus in 2011 and thereafter. So it was too little and it was too short-lived. I have graphs to illustrate this if I really have time, but we'll see. It did help end the global financial crisis recession. The turnaround, the trough occurred in the second quarter of 2009, very soon after the stimulus measures were adopted. But as I say, the recovery was too slow. Now, I think it sort of bugs me when people just talk about this as if it was a mistake on Obama's part to not have the fiscal expansion be larger or to last longer. It was a mistake, but I think it was a mistake on the part of the US as a country as a whole. This was the most you could get through Congress, given that the Republicans were opposed to it. Regardless of where you want to locate the mistake, whether you want to say political people in the White House could have done better, or they want to blame the Republicans or the American people or whatever, it was a mistake. And what Biden is doing now is making really sure that we as a country don't repeat that mistake, to erring on the side of stimulus rather than erring on the side of risking not doing enough, given that there's sort of asymmetric loss there.
Thank you very much, Jeff. That was an excellent presentation. If I would be forced to summarize it in 15 seconds, I would make 4 or 5 points. First, probably overheating, most surely not risk of strong inflation, but other downsides. And one of those downsides might be fiscal instability over the long run if R gets larger than G. You didn't mention what you diagnosed decades ago, that increasing US interest rates very often tip off an emerging market debt crisis. So that's another possible downside. And finally, you had a downside which we Germans don't think is a downside. If you guys produce a trade deficits, that's great. That's what we hope for. So may I now hand over to?
Well, let me just show you one more slide.
Come on.
Well, no, based on what you said, that here is the. Oh, sorry, I was going to show you the spillover from the U.S. to other countries, but you can imagine.
We want to have a current account surplus of about 10 to 15%. See, then we don't need any fiscal policy here.
Yeah, I know. The Germans always want that. But anyway, the graph I was going to show does say that there is a substantial spillover to other countries from the U.S. stimulus.
Agnès.
Thank you very much. Thanks for the invitation. So I'm also going to share my screen. Okay, so we are two from.
But it's not full screen. Sorry, Agnès. Yeah, good.
We are two from the euro area to show what's happening on the other side of the Atlantic, or what is not happening actually. So I will start with, and it will be consistent with what you just said, Jeff, about the cost of the fiscal response. So everybody shows graphs like the one on the left, where the red bars represent the gap and the blue bars represent the fiscal impulse, so the change in the primary balance relative. So here it's relative to 19, because if you take it relative to the previous year, you get very strange things. So then you can find the 3% output gap in the US, Jeff just talked about. The output gap in 2020 is larger in the EU area. And then, as you said, the output gap is expected to be closed already in 21 in the US, whereas it would stay at something 3-point-something% in the EU area. So what is striking? And so here I put everything in the same figure. So I'm not distinguishing discretionary fiscal policy and automatic stabilizers, because we know that in a sense, the mega fiscal impulse in the US was a way to compensate for the lack of social safety nets. So it's better, in my view, it's better to take the whole general government primary balance, then you get everything of it. But still, it is striking to see that although the output gap, so the impact of the crisis, is less in the US, fiscal response was larger. Then, if you look at the right-hand side, the right-hand side is the cumulated excess savings in 2020 by the households in the different countries. And what you see is that excess savings, so excess relative to 19, to pre-crisis, is much larger in the US than in European countries, especially in Germany. So in a sense, part of the measures that were taken in the US in 2020, part of them were saved, and a larger part was saved in the US. And we know that the money was less, the plans were less targeted than in Europe. So we have to take this into account also when we look at the fiscal impulse. Now, if we take a broader picture, here you have the relationship between GDP growth in 2020, so it's negative everywhere. These are only advanced economies. And on the y-axis, you have the variation in the financial balance. So you see that countries, so the larger lower the GDP growth, so the larger the crisis, the more fiscal response in general, although you have countries all over the place. And you see the US is, in a sense, a kind of outlier with limited drop in GDP, but a huge variation in the financial balance. Whereas the euro area is in the medium position, and you have the UK. The UK had a huge drop in GDP and quite similar response compared to the US. So, and then you have Spain with a huge drop in GDP and a response that is quite in line with the general the regression. So what kind of strategy for the recovery? So the first step, so here, this is for France, but it's the same kind of picture for other countries. So you see monthly GDP over 2020 and the beginning of 21 in France, starting from zero pre-crisis in February. And then you see the first lockdown, which was horrible in France, minus 30%. And then the recovery, which was very, very steep. And then we kind of stopped at around 4%, second lockdown, the recovery. And before the third lockdown, the French economy was navigating around minus 4% compared to pre-crisis. So the first step is a no-brainer. It's to recover the pre-crisis level. So most forecasters predict that this level will be recovered in 2022. Maybe the question is, why not 21? And I think the debate is a bit twisted, because I think the main reason why we can probably not recover the pre-crisis level in 21 is not because of the fiscal policy, it's because of the vaccination delay. So there's a kind of 3-month delay in Europe compared to the US in terms of vaccination. And it doesn't make sense to stimulate demand where you have no supply because the shops are closed, basically. So then the impulse will be concentrated on the second part of the year, or even the last part of the year. And so this is quite tricky. Now, more broadly, the challenge, of course, is to recover potential GDP, so to close the output gap. And as you said, which output gap? What is potential output? So there are two possibilities. Well, there are many possibilities, but here there are two. So this is also for France. You have the pre-crisis potential GDP path, which is in dotted line. And then you have one more path for potential output. So the big question is whether the pre-crisis path of potential output can be recovered, or whether, like in the previous crisis, you have a permanent drop in the level of potential output. So there are various arguments around. The consensus today tends to be of a limited drop, but still a drop in the level of GDP. So here we have 2.25% drop. It could be less, it could be more. Then the question, so here in the black line is effective GDP. The big question is how to test this level of GDP. So it has to do with inflation, to see whether there is inflation. But for a small open economy like France, and for a country which starts with a current account deficit, there is a risk that too much impulse on the demand side would stimulate imports rather than output and employment. We have to be very, very careful that the impulse is not only directed to the demand side, but also to the supply side. And there's a big challenge in terms of reallocation of labor and capital, in terms of compensating for the lack of education during the lockdowns, things like that. Now, Hans-Helmut, we were talking about next generation EU. So here you have a picture for the EU. The blue lines are the recovery plans in the different countries, and the red bars are the part that is funded by the European level. For a country like Spain, the whole recovery plan is financed by the EU, and actually the transfer is quite large. It's almost 6% of GDP. Whereas for the Netherlands, France, and Germany, it's mostly national. The largest part is national. So this is important also to think about after the crisis, what would be the fiscal sustainability, because for a country like Spain, it's not so difficult to come back to, well, it's not so difficult to keep the deficit stable, because the money comes from the EU. It's not a deficit actually. Whereas for a country like France, which on the top of that doesn't have a very good record in terms of adjusting its fiscal balance when there is a recovery, it will be much more of a challenge. Now, I recommend you not to look too much at the right-hand side of the graph, because some countries have plans, some recovery plans over a very long period. So you have huge figures in terms of annual GDP, but that doesn't really make sense to compare. So I will finish with maybe a longer view about fiscal policy in the euro area. And I think we should think about what are the common goods of the euro area. And Maastricht was built on the idea that the common good was financial stability. So in order to avoid financial instability, you need to have fiscal sustainability, because when the debt is non-sustainable, then this triggers a lot of financial instability within a monetary union. What we have discovered after the previous crisis, and we are still in this position, is that there is a second and a third common good. The second one is macroeconomic stability. And this is about short-term recovery, and it's about inflation. If inflation doesn't recover in the euro area, it's going to be extremely difficult to carry out to reduce the debt level, corporate debts and public debts, and also to carry out the relative price adjustments. So it was already understood after the previous crisis, and it's still the case today. And we have a third public good, which is long-term growth. It's about welfare and hence political stability, but it's also about public and private debt sustainability. So how to do that, and what is the role of fiscal policy in that? We already know that debt sustainability is key for financial stability. It's not the only ingredient. We know from the Spanish crisis or the Irish crisis that it's not enough, but it's clearly part of it. But then what is needed also is an appropriate fiscal stance to carry out countercyclical fiscal policy, which is quite difficult in practice, and this is about macroeconomic stability. So fiscal policy has to also to participate, to contribute to macroeconomic stability. And third, there's an issue of long-term growth. And here, it's about the quality of the public spending, investment versus consumption or transfers. And I would say that the fiscal rules, you cannot encapsulate all these objectives in just one rule, one fiscal rule. So we need to think about other elements of the governance. And my suggestions would be to reform the Stability and Growth Pact and the macroeconomic imbalance procedure, which is a procedure to, and more generally, the governance and the European semester at the same time. In order, for instance, I think it's hopeless to introduce notion of the quality of the public spending in fiscal rules that already have to deal with the sustainability and the fiscal stance. So it would be wise, in my view, to have, of course, surveillance of the quality of the public spending, but it's about growth. It's about investing in the future, in the greening, in the new technologies. So I would keep it out of the fiscal governance in a strict sense and deal with it in a different way. So I think I'm done. Thank you very much for listening. And now
we have to thank you, Agnès, for an excellent presentation. This is really a public good. It shows the teacher. Actually, I'm asking, can we use your slides and put them on as we might do with Jeff's on our website?
Fine with me.
Yes.
Because I now like to do a little bit of a commercial. Agnès has been writing a number of very good blogs at the French Finance Ministry's website, which gives some additional flavor to the argument. If again forced to summarize your presentation in 3 or 4 points, what I find really important is this is not a demand shock where you just pump up, prime the pump in order to get back to the output gap. You would like to give relief to people. There's a supply issue, maybe a structural one. So we really don't know, that's your point, where the output gap will be afterwards. Then what I really found interesting, you must be French. Because you must be French, because you alluded to the current account, potential current account disequilibrium. In France, they spoke about les grands équilibres, and the current account was always perceived as a threat, which one has to deal with.
Well, to be sure on this, I don't mind a current account deficit. What I mind is that you actually, by stimulating the demand, you stimulate the employment in another country.
That was the Mitterrand push in 1982, 1983, which was really felt in Baden-Württemberg. So the other one is, what I see from your data is, of course, that there is a very significant risk of tensions in Europe arising, because the capacity, fiscal space to respond has been very different across Europe. Structures, in particular in those countries with a high share of tourism, will have to adjust, and that's why I thought that at that time when you came up with this French-German proposal to do a significant grant initiative was so crucial. So now I hand over to the other suspect, Jakob. I've presented you guys so long that I might do that in a very brief way. All due apologies, Jakob.
Yeah, no. Look, it's a great pleasure and honor to be speaking after Jeff and of course Agnès, and we have the opportunity. And now we've known each other for a long time as sort of chief economists to exchange views. And I think one thing you said, and of course Jeff also mentioned, and Agnès emphasized, is that this is, of course, simultaneously, this crisis, a demand shock and a supply shock. And I think it's very important to bear that in mind. And had I prepared slides, which unfortunately I haven't, I think I would have, after these two excellent presentations, zoomed in a little bit and looked at, for example, unemployment. For me, it's an important question, you know, how does your unemployment behave? And if you sort of look at some of the short-time work initiatives, it's quite remarkable how, as you removed the wage bill to an important extent as a fixed cost for businesses, they were able to keep on the workforce. So unemployment hasn't really gone up that much. If you look at household income, both in Germany and in France, it's quite remarkable how household income, the question is then, do they spend it? And Agnès has shown the savings rates. But if you just look at the income, there has been a lot of stabilization success, and I think that's quite remarkable. So I think when one thinks about the question, well, how much is enough? I think it's difficult in a situation where one has the simultaneous supply and demand shock simply to say this is, you know, just like any other crisis. It has some specific characteristics, but I have the impression when I look at those sort of data that in the euro area we've done a lot. Whether we've done sort of always the right thing, and Jeff, I think, made the point very well, that it's not only a question of how much you spend, it's also a question of what you do with it. So there's no guarantee we've always managed to get things right, but I think both in terms of overall volumes and in terms of composition, the sort of slightly below macro indicators that we have look reasonably encouraging. And then if you look at the overall volume in our latest projection, you know, debt to GDP ratio, we started off in Germany at the end of 2019 with just below 60% of GDP, and now as a baseline projection at the end of 2021, it goes up to shy of 75%, and only part of it is a base effect. Of course, we had GDP going down by just shy of 5 percentage points, but that doesn't. So the main effect is, of course, that we increased our debt levels with fiscal policy. A fiscal policy where at the center of it, in addition to rather large guarantee programs in order to help businesses, we had a stimulus package to the tune of 6% of GDP. That was, broadly speaking, 1/3 sort of supply side stabilizing the balance sheet of companies, 1/3 consumption. Some of the measures we're now studying afterwards to see what was actually delivered. For middle and low income families, additional child benefits. We had a temporary VAT cut, and so on. So we had, for example, on electricity taxes in order to finance renewables. We had something that helped households, and so there were these demand side elements, and of course roughly 1/3. Transformative, a lot of energy transition of the car industry, digitalization, and things, frankly, we need to do anyway, and we took the opportunity to do them now in an accelerated manner on a relatively large scale. And one way to tell the story is, of course, the way that Agnès told it, in terms of what next generation EU delivers. But if one takes a sort of historical perspective, I think both France and Germany realized, and that's why it was possible to come together, that there would be a danger that, especially on the transformative side, with countries, especially those with large tourism sectors, most affected as a result, that maybe they wouldn't have the bandwidth, the fiscal bandwidth, to address the immediate supply and demand side issues and then successfully engage in the transformative side of things as well. That's why this whole program was set up. And in some countries, it was more like repackaging already existing plans. In some countries, it was really, I mean, Agnès gave the striking example of Spain, really making it possible to engage on that scale. And I think in an environment at the zero lower bound, in an environment that is in many respects challenging for a number of countries anyway, this was exactly the right thing to do. And I'm not so worried because, of course, what brings us together is this transatlantic comparison. Is this stimulus bigger, too big, too small? I think sort of the impression I get looking at the slightly sub-macro numbers is that probably we are on a reasonable fiscal path. We have to make certain that we don't consolidate too early. That's, I think, important as well. We had a reasonable fiscal response helped by a large-scale European measure that is now really going to happen, and money will be paid out starting July, and that's I think really that's excellent. That's excellent news. And so rather than, you know, is this 0.5% too little or too much? What I worry more about is that we not only turn this into success in the sense of you know, looking at from it today, but we want to make certain it will be looked as successful, especially this European side of things, looking at it in 5 to 10 years from now. So that with hindsight, we can say this a really leap of faith among member states that helped us to bring this package together did pay off, that the money was spent well, that it really did help to kickstart economies after the crisis, put them on a good growth trajectory, and create a political environment where this unique program then can help us build a more solid foundations for our common currency and our fiscal architecture in Europe overall. And that I very much hope that this is going to happen. So when one says sort of on different wavelengths, I think in terms of fiscal policy, while the conditions are a little bit different, of course, there's been the great relief of the election in the US and so on. I don't really see us fundamentally on different wavelengths fiscally. I do see us, unfortunately, perhaps not on different wavelengths, but with a significant delay when it comes to vaccination in Europe. That's costing us at least a quarter, possibly a little bit more, but that's the way things are. Now, also on the vaccination front, we are starting to catch up. So I think in spirit and outlook, I should think we're more synchronized transatlantically than we have been in a long time. And so on this optimistic note, I close my short introduction. I'm much looking forward to the discussion.
Vielen Dank, Jakob. I would have been completely flabbergasted if you wouldn't have been optimistic. I've first time heard the notion of sub-macro, and I like it very much because you went into details with regard to, and there's a difference between us and the US, by the way, with regard to unemployment. If you look at unemployment level in Southern Europe, they do not compare at all with what has been happening after the great financial shock. And that was an upshot of SURE, or the support given to those economies in terms of implementing what Germans used to call Kurzarbeit. It's a very, very, very important topic. What I would find interesting is the following issue. Couldn't we see, as a result of what you've been explaining about acceleration of processes, couldn't we see actually an increase in productivity now with all those digital stuff, for example, being implemented, with a much higher intensity than it used to be the case. So couldn't we even build on that some sort of I shouldn't say promises, expectations which would be really positive? And doesn't this high pressure economy, as it was called decades ago, couldn't that contribute to that? So with this assortment of issues and questions, I leave it to the panel to interact a little bit. Who would like to come in first? Jeff?
One thing I was wondering about from Agnès, and I also see in the Q&A where we've got 5 questions, is one from someone with initial G. And I've sort of been wondering about it myself. Of course, it's right that the experience of the pandemic is not just like a global financial crisis, which I guess I never thought I'd call the global financial crisis a garden variety recession. But anyway, the fact that it's prevented people from going to work, and it's been a big adverse supply shock. Well, 2 questions. One is, I suppose we should infer that the adverse supply shock and demand shocks were roughly equal, because we haven't seen inflation, depending how you treat commodity prices. We haven't seen inflation strongly rise or fall during the past year. The other question is, if we think it's a supply shock, should we be reflecting that in our estimates of potential output? This is a question that's also in the Q&A chat room. We don't. I didn't. You don't. CBO doesn't. But if we had some measures, conceptually, some measure of potential output, it's supposed to be the capacity that the economy can produce under. Should our graphs, at least conceptually, be showing a sharp fall in potential output last year?
Thanks, Jeff. By the way, you're taking my moderator's role. I was supposed to throw the questions at you.
Well, I was going to ask it anyway.
Don't do that ever again. Agnès?
Okay, on your question about productivity, yes, you're right. This crisis has accelerated the investment, especially of SMEs, in new technologies. However, first, we don't really know the impact of telework on productivity. It may be more question of, telework in the sense of not constrained telework with kids in the house, but teleworks, let's say a few days per week. We have little firm evidence on the impact on productivity, so we should not extrapolate too much. And then, so there is the pinching effect, which will be there. So we are going to have a higher number of failures over the year compared to normal. We estimated something like plus 80%. So something that also includes the catching up relative to 2020, where the number was lower. And so this is the order of magnitude built on several indicators. It's large. It's not huge. It's comparable to the previous crisis over a smaller period, probably. The problem is that the cleansing effect is less effective this time than in previous times, because those firms at risk of being insolvent or illiquid or being kicked out of the market, we estimate that they are, on average, they have a lower productivity than the other firms, but the gap is not so large compared to normal times. So we cannot really count on this effect. And then there is the corporate debt that is here to stay. It may have a negative impact on investment. And finally, there is this issue of human capital, so students that have not studied as much as they would have in normal times, the difficulties in the youth coming into the market. And we know that when the youth find it difficult in their first years in the labor market, they have a scar for a long period. So we can be reasonably, and then finally you have the reallocation effect. So there is a persistent, there will probably be a persistent, if not permanent effect of the crisis on, say, international tourism, on the aircraft industry, we don't know exactly. And so meaning that some workers will have to retrain and find another job, and this takes time. So it may be that potential output recovers eventually, but it may be also that it takes time, and that we will have a number of years where actually, I'm not saying that we cannot recover the pre-crisis path. I'm saying that it is a challenge, and that the policies should be also geared at that, not just at stimulating demand. And we should be very careful in our way to measure the tensions on the supply, and we are already seeing some tensions in some professions. It's very difficult to hire people in with digital skills. Today, it's already the case. So as usual, since it's a sector specific, and this has been shown in literature very well. So it's a sector specific crisis with spillovers on the other sectors. And so you could have tension in one sector, but not in other ones. And you need to take into account all of this and not just think about aggregate macro indicators.
Thank you very much, Agnès. Jakob, Agnès, I don't know if I may ask you that, but Agnès emphasized three issues which could easily turn into banking sector troubles, namely higher failure rates, a need for structural reallocation, which will take quite some time, and also this topic of debt overhang in the corporate sector, which has been, by the way, an issue we at SAFE dealt with when we came up with our proposal that one should think much more about injecting equity into firms. Jakob.
I mean, these are important questions, and I think that's another example for an area where the starting point really matters. There are countries that have had before the crisis very well capitalized, a very well capitalized corporate sector on average. There are other countries where the corporate sector was slightly less well capitalized, and of course, if you're less well capitalized, and then this kind of shock creates greater balance sheet vulnerabilities. In addition, and I think that's also quite interesting to look at in more detail, and I think will also lead to a lot of interesting publications. If you look at the company support programs, this mix of debt instruments, guarantees, and equity enhancing instruments, short-term work, of course, helps you with the equity, but there are a lot of non-repayable grants, especially for small and medium-sized businesses, that precisely have the idea that maybe it's too complicated to give them a lot of debt, and then have clever schemes of working things out, even though theoretically, both in terms of equity, because some of the people who are receiving the funds, they're millionaires, and in terms of what theory might tell us, maybe it would be preferable to start with debt, but in practice, working these things out can be really complicated. So some countries, including Germany, opted for a relatively generous approach there. Of course, we have the debt instrument, but a lot of basically grants as well. So I think you'll find the situation varies a lot country by country, and of course it goes without saying sector by sector. So I don't think one can draw general conclusions from that. If you look, for example, at the bankruptcy level, another sort of sub-macro indicator, even though we're almost back to normal in Germany in terms of our legislative framework for when do you have to declare bankruptcy, there's an uptick in the numbers, but it's not that huge. I think another indication that despite some of the criticism, you always have criticism when you try and do a program like that, that sort of broadly speaking, it was about right-sized. And so I think it's difficult to generalize, and this is not only a transatlantic matter. I think we'll find some heterogeneity within the EU, within the euro area as well on those parameters, and we need to be mindful of them, both in terms of how one thinks about each other, sort of in Eurogroup conversation, that sort of things, and also in terms of one's prescriptions. So that's an important point, but I think we need to be careful not to generalize here.
Thank you very much. So now I try to cover some of the questions which we see here. And the first two which I combine have to do with debt and debt levels. They are from actually my teaching fellow at Freiburg, Weizsäcker, and Niels Bühnemann. Their question is, should one look for debt over GDP, or should one look for a more cash flow oriented perspective? Are we, given that we are now way above 90% in deep trouble? Who would like to take them? Jeff?
Okay. Yeah, I mean, there's this common view that we economists all in the past agree that there's some critical level of debt to GDP, like 90%, and now now that's being rethought because what matters is debt service. I don't think that was really ever our view, including even Reinhardt and Rogoff. They made the mistake of using the word threshold to describe 90%, but they also wrote about debt intolerance, that different countries, depending on their circumstances, can tolerate or get away with much higher levels of debt to GDP than others. In particular, advanced countries have over the last 20 years have had higher levels of debt to GDP, whereas emerging market countries have brought them down and have gotten into where they've gotten into crisis troubles, like Argentina or Turkey. It's with much lower levels of debt to GDP, and Reinhardt and Rogoff recognize that. I think the problem with focusing on saying, well, interest rates have come down just as much as debt has gone up, so that debt service ratios are no higher than they were before. The problem with that is that it's very vulnerable to an increase in interest rates. And yeah, there is this view that interest rates maybe now are permanently lower due to secular stagnation, but we don't know that that's right. And we have to, so my answer is, it's not the level of debt to GDP that matters. It's if you project into the future with assumptions about, reasonable assumptions about primary budget deficits and rate of growth of GDP and interest rates and all that, do you see a path which is pretty reliably going to come down the ratio of debt to GDP that's sustainable, that you don't have to worry about, even if today you have a high level? Versus what happens all too often is that the path is upwards, or there's a danger, even if it looks like, even if you're you have projections that look like you can squeak by with a stabilizing path. All it takes is one little adverse shock to get you into this trap where the interest rates go up in a problematic country, even more than worldwide, because of fears of default. And any move to cut the primary deficit and turn it into a primary surplus slows down growth, which I think has happened in Greece and other periphery countries after the euro crisis. And even if you're close to the borderline of debt sustainability, it doesn't take much to push you into an unsustainable situation. So I would say that's what really matters, and it's certainly what matters for emerging markets, or for countries that can't borrow in their own currency. European countries can borrow, well, the euro as a whole can, but the individual countries like Greece and Ireland can't borrow in their own can't issue their own currency, I should say, don't have their own currency. And the U.S. we able to get away with even more, because not only do we borrow in our own currency, but it's the premier international currency.
Thank you very much, Jeff. By the way, nobody of us can issue in our own currency.
Right.
We are really sub-sovereigns in that case for purpose. Jan Kran, the director of SAFE, actually the person who made this all running, has a very important question. critically or skeptically critical. He asks, in hindsight, what would be the criteria to define the next generation EU program as a success, 1, and 2, what type of institutional reforms are required at the national level to make that fly? Who takes that one?
Okay, so if I may also say a word on the previous question, because I think this is really a question of trade-off between two risks. You have a risk of premature adjustment, and we should not think just about the debt to GDP ratio. There's also the off-balance sheet liabilities. We have increased very much the off-balance sheet liabilities with the guaranteed loans to the corporations. So tightening too fast could also trigger a materialization of the risk. So this is on top of the debt. And on the other side, you have the risk of a self-fulfilling crisis. So probably today we can live in a world with more debt for different reasons. We know all this debate about the decline of the natural interest rates. But still, I think it's a question of risk management for each country, and rather than an absolute level of debt to GDP. So we have to sort this out. So about the question on next generation, and probably Jakob will have more insight on this. I really think that the stake is very high for the EU to make it a success. And to make it a success, there's a need for excellent governance, that the money is correctly spent, a lot of transparency, and which doesn't mean bureaucracy. So there's kind of confusion between bureaucracy and governance and transparency. We are in the in fact, we are trying to put everything in open data, so you can find on the internet who's got the money and what for, and to do some evaluation in definitive. This is extremely important, and extremely important to avoid red tape or other things. And then what is a bit ambiguous in this project, it falls in between the recovery plan and the transformation plan. So it's not really a Keynesian recovery, although it is partly this, but it's not. It's neither the 10-year plan of investment that Jeff presented for the US. So it has to have because it is consistent with the pre-crisis strategy of the EU, spelled in the green strategy of the EU. So it's consistent with that, but it's not a short-term recovery package. So there is a challenge here to invest quickly enough, but with good investment. And we all know that there's a trade-off between the quality and the speed. So sometimes smaller projects can be delivered quicker and still be of high quality. So we will have this trade-off, this challenge ahead. But Jakob has worked more on that.
Jakob, so we have 5 minutes to go, and I have a couple of other interesting questions, but take your time.
The pressure is on.
No, time is our ultimate constraint.
I can't resist to briefly say on the question of the debt level. Of course, debt levels remain important, but I think we can be glad that we have to deal with big challenges like energy transition or the COVID crisis in an environment where the real interest rate is relatively low. I think if you think about the counterfactual, if it were significantly higher, in many ways, there's one exception, of course, monetary policy, but other than that, it would make things much, much harder. So I think in that sense, it helps. But to pretend that debt levels simply no longer matter would be the wrong conclusion, but the right conclusion is we are in a relatively benign environment, and that brings me to the next question. We need to make the best of it. And I think in terms of Jan Peter's questions of what constitutes success, of course, I would say there's sort of a micro or input legitimacy level where I think it's important when you have a EU program like that, it's European taxpayers' money, then it's important that it's well documented and well executed, that you do reasonable things at the micro level. And that's important for the legitimacy of that program. But it's also important to have a macro, or if you like, output legitimacy, that in addition of projects being executed properly, that overall the outcome is positive in terms of growth, in terms of the objectives that were set. And so I think there are these two levels. There's the micro level, you give a kind of tied grant, and then, where that's in the US, states not doing what they're meant to do with that tied grant, that leads to trouble, obviously, would be the same in Europe. And then there's sort of the macro element. We want member states to do what they can in order to have a positive growth dynamic post-COVID. And so for me, these are the two dimensions that constitute success. I think for many taxpayers in northern countries, one mustn't underestimate the micro side of things, but one mustn't underestimate the macro side of things either.
Thank you very much. There are two questions which I think we could finally address. One is by Ronald Weichert, formerly of Deutsche Bank. Ronald is asking, what happens after the big push, after the big boom? Are we doomed to go into a recession in 2023, 2024? The second question is Timo Klein, who asks about, there are massive structural adjustments happening. We see delayed insolvencies. What's the turnout there over the next few years? 2 minutes max left. Split between the three of you.
I can be very brief and go first, simply saying, I think one of the big questions, what's going to happen with the savings overhang? I mean, the money that was accumulated there, and there's some theories out there who say, well, it will be golden 20s because in addition to all the stimulus, people will go out and spend it all. And there are others who say, well, people will be so much worried. There was the financial crisis, know that now there's COVID. What will be next? And they'll just sort of sit on the savings and say, you never know, better be safe than sorry. And probably the truth lies somewhere in the middle. But I think this idea that sort of we'll have this big hangover afterwards, it's not something that I subscribe to. I think if we do the right set of policies now, we'll have not a worse, but a much better period once COVID is over.
Agnès?
I agree with Jakob. First, there is an upside risk with the accumulated savings. We don't know what people are going to do. It's possible that they spend it. We just don't know. Second, investment has been quite resilient during this crisis. It has not, well, it has, of course, it has dropped, but not more than value added, which is quite an achievement. And investment in new technologies has resisted, which is good for the future. And so when we talk about very fast growth in 21 and a bit less in 22, a bit less in 23, it's a catch-up process, a catching-up process. So if the question is whether potential growth will be higher after the crisis than pre-crisis, I'm quite skeptical about that. But whether we can recover the same potential growth as pre-crisis, given the fact that it was not a financial crisis, it's an exogenous crisis, we should always keep this in mind. And the reaction by both fiscal policy and monetary policy was just massive. I think we can be cautiously optimistic about the future.
Jeff?
Ronald Weizsäcker was asking specifically about the effects of the U.S. Fiscal expansion on beyond the next 2 years into 2023 and 2024. And of course, there's so much we don't know about the predicate. Who will win the midterm elections in November next year? We could have a repeat, and it usually happens that the out of office party, out of the White House party, recoups some seats, and the margin is so narrow, we could have a return of the Republicans, and we could have a repeat of what happened in the Obama stimulus after 2010. But my short answer is, regardless of that, my best guess is that U.S. fiscal expansion and economic expansion will remain strong in the coming years. And I think on that, most likely that will have a positive effect on the rest of the world. There is an alternative concern, which is that interest rates rise, and there's a switch from risk on to risk off attitude among investors, and the stock market crashes, and it's particularly emerging market countries are quite vulnerable in terms of their debt situation. So that could happen. But my baseline scenario is on net, I think the fiscal expansion will have a positive effect on both the U.S. and the rest of the world.
Thank you very much, Jeff. I won't summarize what we had here. What I think is we have a couple of open questions, which probably makes sense to invite you guys for. This was a really excellent webinar. For example, Agnès spoke about the need to rethink the Stability and Growth Pact and the macroeconomic imbalance procedures. And that's a debate going on in France now very strongly, and we should take note of that. The second thing is what Jan Graan highlighted. This has to be successful. If it doesn't, it will massively backfire. So governance at the national level there is really important, and what's happening in Italy is crucial. Europe is, to quote Dick Cooper, who unfortunately passed away in December, Europe is structurally interdependent. It is important for all of us that everybody's doing somehow well, and that's why I was so happy when the Next Generation EU initiative was launched. But there are a number of questions which come out of this, and I think our panelists have been marvelously contributing to that debate. So I'd like to thank you. Thank you very much for having joined us, and I would also like to thank the audience, and I really hope we see each other soon in person again, and we would even fly in, Jeff. Thanks a lot.
Thank you.